overall, if you see in terms of Nifty 50 as well, interesting moves that are coming in. We're at the day's highest levels with gains of nearly 1.3% coming in there. And if you see in terms of Bank Nifty as well, again, strong moves coming in terms of Bank Nifty as well. There you go, 1.6%, clearly outperforming the benchmark indices. Let's pick up the top gainers and top losers overall in terms of Nifty 50, because that's going to be interesting to watch out for. Contribution, Reliance Industries, 58%, L&T, ICICI Bank, as well as HDFC Bank. These are the biggest contributors to the markets, though you're seeing some pressure in terms of Infosys. Cipla is under pressure, and this is on the back of the commentary that we've heard in the con call, where two of the product launches that are getting delayed by 2 to 3 quarters, and that is going to be cumbersome. TCS is trading under pressure. ITC ahead of numbers is down in trade. Moving on, if you see in terms of Bank Nifty components as well, let's just pick up the top 5 gainers in terms of Bank Nifty as well as the losers as well in terms of Bank Nifty. It's only AU Small Finance Bank which is reacting to numbers and is under pressure, but apart from that, all the others are up and about in trade. Bank of Baroda, PNB, IDFC being the top gainers in today's day of trade. Let's pick up the mid-cap and the small-cap index. That's what the show is all about as well. Mid-cap, 0.8 to 0.9% higher, whereas if you see the small-cap index as well in trade, almost 1%. So clearly you have the benchmark indices which are outperforming the broader markets in today's session. One stock that is in focus in today's day of trade is a Shriram Finance. Let's pull up that counter on the screens and see what the stock is doing in trade. 3.5% up move. And this is mainly in terms of the earnings. If you glance through the numbers as well, a 17% up move in terms of top line. Asset quality has also improved marginally. And in terms of the total AUM, that has seen a growth of around 21%. YS Chakravarti, MD and CEO at Shriram Finance, joins us. Mr. Chakravarti, good morning and welcome to the show.
Morning, Hiral. Very good morning.
Mr. Chakravarti, my first question coming to you is overall, in terms of the kind of growth that we've seen, what has worked during the quarter, and are you expecting this kind of performance to continue in the coming quarters?
I think the major factor is the merger and the expanded reach for certain retail products. So at the beginning of the merger, we have guided for about 15% growth. But I think majorly the growth also has come. One is because of the strong economy, and the second one is also because the retail we were able to provide the retail products in a lot more offices. Basically, Shriram Transport has about 2,000 outlets, and Shriram City Union Finance had about 1,000 odd offices. Now, in about another 1,000 Shriram Finance outlets, we are now able to offer gold loans, MSME loans, and to an existing Shriram City's two-wheeler customers, also personal loans. So you see growth in all these segments outstripping the growth in the commercial vehicle. So I think that's the major reason.
Right. So when you speak about the effective merger synergies with regards to housing AUM, that has crossed 12,000 crore. The product mix has also improved. And you have your asset quality and return ratios, which are largely stable. Going ahead, then, which are the segments that will drive growth for the company?
See, our focus, obviously, about 70% of our portfolio is vehicles. That we will continue to focus on that. In the vehicle portfolio, passenger vehicles could be cars or buses. I mean, any passenger transport vehicles would outgrow the commercial vehicle business. Then focus on MSME, loans to MSMEs, and the gold loan. These are the three that will actually give us the growth going forward.
Okay. And apart from that, if you see from, the other aspects, your operating and credit costs have been higher this time around, and that is something that everyone is watching out for. What's the trend looking like going ahead?
See, probably on an absolute terms, yes, they have gone up, but as a percentage, if you look at it as a percentage term, in a percentage term, I think they are trending downwards, and we are actually focusing on, probably we are guiding for a small every quarter a downward trend. It may not be very significant, but it's a steady improvement in delinquency is what we are guiding for.
Okay. And overall, would it be right to say that around 20% AUM growth in 24 and the same thing can be maintained in 25, or do you think 25 will be slightly lower?
No, 25 will be, we are projecting a 15 to 18% growth for the next couple of years.
Okay. Overall, if you see in terms of the calculated NIMs as a percentage of the AUM, that has gone up to around 9.65% on a sequential basis. And there has been a slight moderation in yields of around 5 basis points that was, offset by a higher decline in the COF by around 30 basis points. So overall, if you have to move from here on, what is that number expected to look like? And where will you be able to maintain your margins at? Will it be in that 8.5% to 9% bracket, or do you think it can go beyond 9%?
No, see, to be honest with you, it's very tough now to take it beyond 9. I think we will be between 8.5 to 9. It will be hovering around that. So, I mean, reasons is one, I think our products now we have priced them optimally, number one. Number two, the cost of funds also depends on cost of funds. If the cost of funds improve, probably we should be able to do it better. But as of now, it's 8.5 to 9.
Okay. So when you talk about credit cost as well, where do you think you will be able to maintain that? Because it did increase by almost 12 basis points this time around sequentially to 2.4.
See, the long-term goal is probably from 2 years is about 2%. And we are confident that we should be able to achieve 2% next financial year.
Okay. And when you talk about Shriram Housing Finance as well, I mean, a good AUM growth over there. Asset quality has also remained pretty much pristine this time around. Any thoughts in terms of a capital infusion coming in on that front through direct investments or external investors?
See, if you look at their leverage, in fact, I think they are actually crossing. They have already crossed six times. So they definitely need a capital, and probably they would need anything above upwards of 1,500 crores of capital going forward. So we are in various. I mean, we are actually exploring various options of probably either a capital raise, external capital raise for them. Internally, we wouldn't want to put in the entire money. So we are actually exploring options of inviting some private equity guys onto the board, and we are in those discussions. Nothing is finalized as yet.
Right, and there would be no thought process to see a complete sale of the subsidiary?
Too early to think about it. I mean, anything depends on the value that you get, right? So it's too early even to.
So tell me one thing, Mr. Chakravarti, if we are looking at a capital infusion, however it might be, through a combination of external PE funds coming in or a combination of PE as well as internal, how much is the need of the subsidiary? How much capital do you think will be needed? And with that capital, how much growth are you anticipating?
Let me put it this way. I think there are very few HFCs which are sitting on a 20% capital adequacy, right? Most of them are sitting on upwards of 40%, which is also giving them a lot of, end of the day, the cost of fund advantage cost. So I would say a minimum 1,000 crores is what is needed in the near term for at least next 1.5, 2 years. They would need at least 1,000 crores. So we anticipate the company to grow at probably next couple of years at 30 plus CAGR of AUM. Though they have grown by about 60% this year, that's basically because of a small base. But going forward, I think we're projecting a 30-35% of growth for the next 2 years.
Okay. And apart from this, if you see in terms of the return on asset and ROE, are you expecting any improvement, or you think where the company is currently is what should be good enough?
I think we should be able to do reach around 3.5% is what we are looking at.
Okay. And any pressure on NIMs that you are taking into consideration, maybe due to inability to improve yields or the persistent increase in the cost of funds or higher than expected credit cost? If you have to look at these three, how big a risk can that be and how much of it are you factoring in?
See, as of now, I think all the three are behaving, I would say, we are comfortable with all the three as of now. Depends on the regulator. And honestly, I don't anticipate any increase in rates going forward. Whatever rates, I think we have seen the upcycle. Hopefully, next 6 months, second half of the next year should probably give us some relief on the rate front is what I'm anticipating. And the second point is also the recent increase in risk weightage on unsecured loans and also has not affected us much. So I don't think there would be any risk on the rate side or on the delinquency side. So I do hope that we are positive that the next 2 years the environment would be benign and conducive to growth.
Right. So I think this is a good trajectory that everyone is watching out for as well. Thank you, Mr. Chakravarti, so much for speaking to us at NDTV Profit. And almost a multi-bagger that we're talking to, 92% is the kind of returns that we've seen in the last 1 year with regards to where Shriram Finance goes. Today also the stock is seeing some smart moves. But let's quickly slip into a short break. Up next, we will be joined by the management of Cupid to discuss their quarterly numbers as well as the fundraise that they're looking at. And this is an absolutely new management that we will be speaking to. Managing Director Aditya Halwasiya will be joining NDTV Profit. Please stay tuned. Welcome back. You're watching the Small and Mid-Cap Show. Let us now move on to Cupid, that recently reported its third quarter numbers. Overall, if you go to see the revenue, slight dip coming in there at 40 crores versus 42 crores on a year-on-year basis. Margins, again, have seen a dip as well at 31.58 versus 32.81. And the profits have seen a dip this time around as well. A couple of things that we need to discuss with regards to where Cupid is concerned is in terms of the recent land parcel that they've acquired to improve capacity. Secondly, the stock split as well as the bonus issue. And thirdly, the fund raised via preferential warrants. So lots brewing with the company. Joining us on the show is Aditya Halwasiya, Managing Director at Cupid. Aditya, good morning and welcome to the show.
Good morning. Thank you. Thank you for having me on the show.
Aditya, my first question coming to you is, if you see in terms of the third quarter numbers, there has been a slight muted move in terms of the top line margins and profitability. What's the reason for that?
So overall, with our current plant at Cupid Limited, we are seeing a very plateaued growth, close to plateaued growth because of the capacities we have installed. Simultaneously, the markets we were already targeting prior to the new management taking over, it was close to 150 to 160 crores worth of top line. So these numbers year on year will be improving as we bring about capacity expansion plans, which we have via internal accruals. And simultaneously, we'll be also approaching other geographies for our product offerings, and primarily in female condoms and in IVD test kits.
Right. So, Aditya, what is and how has the strategy now changed pre and with the new management?
Sure. The strategy is to target more geographies, as I mentioned, and just work on getting tenders for our international orders for the start, and simultaneously get into the domestic market in a big way in India. So we will be liking to get into tendering business for our female condoms and IVD test kits in the coming future, because the margins over there are much higher than male condoms. So we'll be focusing, we'll be changing our product mix a little bit in terms of target we'll be attributing to them. So that is a very holistic view. Anything particular, please let me know.
So Aditya, I understand that you're saying that the margins with regards to female condoms is way higher as compared to male condoms, but as a percentage of your capacity, it's still a minuscule portion, right? I mean, 480 million is what you produce in terms of male condoms. 50 million is still in female condoms. How fast will you be able to change that ratio? And if so, what's the target going to look like? How much of your capacity will focus on female condoms if that's going to be the growth strategy?
So just to give an indication on the revenue contributions for male condoms as of today is 70%. And for female condoms as of today, it is close to 20%. So that gives an indication on revenue indication. And when it comes to EBITDA, we are able to get out of the female condoms. We're getting an EBITDA margin of close to 35% from female condoms, and from male condoms, you're getting close to 18%.
Correct. So how, okay. So let me put it another way. Now from 70-20, right? How is that ratio expected to change? Say if you have to take the next 3 years, by how much will your female condoms contribute to in terms of revenues? And two, by how much will it help you improve your margins?
So as we bring about new capacities, we'll be bringing about scale, and simultaneously the magnitude of female condoms the number of female condoms we manufacture and sell will increase. The percentage will be close to 25% female condoms and 65% male condoms. That is what we're expecting. But the magnitudes will increase in a very big way. Male condom capacities are expected to increase by 770 million by FY26, FY27. And female condom capacity is expected to increase by 75 million in FY26, 27.
So Aditya, the 385 crores that the company is raising through preferential issue of warrants, will that be used to increase the capacity? And if so, will that be enough, or you will have to raise much more?
As of today, we'll be increasing our capacities organically we already have purchased a parcel of land close to Mumbai. We'll be increasing our capacities with our internal accruals. We have close to 115 crores as of today in our bank. We'll be utilizing that. We have utilized close to 10% of that.
Okay, and with regards to the 385 crores that you are raising, what's going to be the use of funds?
The use of funds are going to be domestic acquisition or cross-border acquisitions.
Okay, and what segments will you do these acquisitions in?
As of today, we have little clarity on the segments. We'll be either approaching the prophylactic segment, or that is the condom segment, or the IVD segment, or both.
Okay, and what's the trajectory looking like with regards to closing these acquisitions? Will it be done in FY24 itself, or will it be in the first half of FY25?
So once we proceed with the preferential allotments, it takes a maximum of 18 months to get 100% subscription amounts in our accounts to proceed with these acquisitions.
Okay, so which means that at least, say, probably by FY26 is when you will be actually fulfilling the acquisitions.
That will be a very comfortable estimate, yes.
Okay, and with regards to the stock split and bonus issue, what's the rationale by doing both?
We want shares of Cupid Limited to be more affordable to any prospective investor in the future.
Okay, and overall, in terms of FY24, taking everything into consideration, what's the growth number that you're looking at, and how will that improve, taking everything that you're doing together with regards to capacity addition, the acquisitions that are planned, and the change in strategy? How will it improve in FY25?
In by FY25, we'll be executing close to 2/5 of our expansion strategy after getting the land acquisition and after installing the factory sheds and the plant and machinery. We already have a project head and an architecture working on the same. So we could expect a revenue increase of close to 50 to 60 crores comfortably.
Okay, and
by FY25.
Got it. And in terms of geographies, which are the geographies which contribute maximum to your revenues? And two, how much is India currently? And as you said, you're looking to increase your domestic coverage as well. How will that number increase?
So, so when it comes to our revenue contribution, exports contribute close to 90% of our revenues. Domestic contributes 10%. And majority of this revenue is tenders which we participate in, government tenders and tenders of NGOs in and out of India. Recently, we've been successful in being L1 and L3 in the CMSS tender for distribution of condoms in India.
Okay. So how much will that 10% actually then become going ahead?
As of now, I have not mentioned regarding the domestic B2C sales. We'll be approaching it from all channels. It's very minuscule as of now. We've just started 2 months ago. We'll be seeing compelling numbers in the coming quarters to indicate good growth ahead.
Right. All right, Aditya. Thank you so much for having this candid chat with us at NDTV Profit. Good prospects, good rewards that investors do get as well on the back of the strategy that you're using. So that's the management of Cupid. And clearly, if you see in terms of the stock as well, if you pull up a one-year chart, it'll give you an indication of the way the stock has moved. There you go, almost 580, that's 6.82. That's 7 times as the kind of returns that we've seen on this counter in the last 1 year. So a clear multi-bagger in the offing. But that's all that we have on the show, completely out of time. Please stay tuned for more news and updates on NDTV Profit. And this is Hiral Dadia.